Matt the Mortgage Guy here. Wanted to shoot a quick video talking about a simple way to calculate how much mortgage you qualify for. Now, the point of this video is to just give you some basic information if you want to get a rough estimate what you qualify for. Take into consideration when I make this video, I'm making it really general so that it kind of works for VA, FHA, conventional, even though different loan programs will have different requirements. This video will give most people a general idea of what they qualify for and how to calculate that. So here goes. Your gross income divided by your current debts plus the mortgage is what lenders call debt to income ratio. And let's just call it 50% or less, what the lenders are looking for. Some programs 43, some 45, some 50, some even 55 and 57. But in general, the 50% mark will do you justice for doing a rough calculation on what you'd qualify for. So you make $8,000 a month. Your total payments, credit cards, student loans, car payments, all the other stuff that shows up on your credit report, plus the new mortgage can't exceed 50% of your gross income. So gross income 8,000, 50% of that is 4,000. You've got 1,600 in these other payments. You're going to qualify for a mortgage up to 2,400. So something that's very important to consider in this is people say, oh, well, I did some rough calculations on my own and I could buy a house up to 600,000. Take into consideration that based on how much you're putting down, you're going to have principal, interest, taxes, homeowners insurance, and mortgage insurance. A lot of folks that are putting 3% down or 3.5% down don't factor in that $200 a month in mortgage insurance or whatever that number is. The total cost, HOA dues, all of that with your mortgage payment plus your current debts can't exceed 50% of your gross income. And that's the basics of it. There's a ton of stuff to consider, and I could spend an hour and a half talking about all the different variables that go into it, but this will at least give you a rough idea. When you're sitting around thinking, I don't know if I qualify for that mortgage because that mortgage is going to be $2,200 a month. Well, if you have very little debt and you make $6,000 a month gross, you'll probably qualify. Again, this is just to give you a general idea so you can calculate it on your own. If you're looking to get pre-approved and you're serious about buying a house, you always want to contact a professional. It doesn't cost you anything. You submit a loan application and your documents. That way the lender can look through it. They'll review your scenario and say, well, you were calculating your income as $7,200 a month, but when we ordered your verification of employment, since you have variable income, we took a 2-year average, and that 2-year average is $6,400 a month. So things like that is why you go ahead and get a pre-approval. But if you're just trying to calculate on your own, this is a very good way to do that. Take your gross monthly income, times it by 50%, put all your debts in there, plus what the new mortgage is going to be, and those got to fall under 50% in general for majority of loans. Like I said, sometimes 45, sometimes 55, but 50 is a good ballpark number. If you have any questions at all, please feel free to reach out. Matt the Mortgage Guy. Until next time.